Dear friends, welcome to the ICE Learning Platform. We are presenting second video on the basics of accounting. This video is related to history and development of accounting. In the first video, we have presented the definition of accounting. This video may be watched only after watching the first video. The link for the first video is given in the comment box. History and development of accounting. As we know that accounting is very old. It was first used in Babylonia and Egypt around 4000 BC. Romans used a memorandum or daybook where receipts and payments are recorded. China adopted accounting practices as early as 2000 BC. When it comes to India, the famous book Arthashastra, written by Kaudilya of Chandragupta kingdom, also describes the method of maintaining accounting records. From the above, we can see that the accounting is very old. However, the modern accounting has originated in the 14th and 15th century. Luca Pacioli, an Italian mathematician, is regarded as the father of accounting. He wrote a book known as Summa de Arithmetica Geometria Proportion of Proportionality, Review of Arithmetic and Geometric Proportions in 1494, which is considered as the first book of double entry bookkeeping. In the above book, he used the popular terms debit and credit. For a student of accounting, the two important terms are debit, or in short DR, credit, or its short form CR, is very important. First, we can see what is the meaning of these basic terms used in accounting, that is debit and credit. Debit is a word that comes from an Italian word debito, which comes from the Latin word debita, which means owed to the proprietor. Debit, that means owed to the proprietor. The second term is credit, which comes from the Italian word credito, which comes from the Latin word credo, which means trust or belief in the proprietor or owned by the proprietor. So, the Latin and Italian words debit means owed to the proprietor, and the word credit means owned by the proprietor. These terms we will discuss in detail later. Now, we have to understand that two important terms that has to be learned in the accounting is debit, short form is DR, and credit, short form is CR. Luca Pacioli, we have already told that he is regarded as the father of modern accounting. Pacioli wrote all entries have to be double entries. That is, for all transactions in a business, there must be two elements. So we are coming to the double entry accounting system. Earlier, the accounting system was regarded as single entry accounting system. However, the modern accounting system is double entry accounting system. What is double entry accounting system? In double entry accounting system, for all transactions in a business, there must be two elements. For example, suppose one business organization sold some goods to a customer. Here, for the business, goods is coming out of the business, and the customer is paying money for that goods. That means cash is coming into the business. So here two elements are involved. The first element is goods that is going out of the business, and the second element is cash that is coming into the business. Another example is goods purchased for cash. Here goods is one element and cash is the other element. Goods is coming into the business and the cash is going out of the business. So, the modern double entry accounting system says that for all transactions in a business, there must be two elements. One is the outgoing element and other one is the incoming element. So, for example, goods purchased for cash. Here goods is coming into the business and cash is going out of the business. Another example, sold goods to John on credit. Here goods is going out of the business, but cash is not comes in immediately as goods is sold on credit. Sometimes business organizations may sell goods on credit to customers. That means they are paying the money on a later date only. That means the money is not received on the same day of the sale. It will be received after 30 days or received after 45 days or something like that. The person who bought the goods on credit is known as debtor. The person who bought goods on credit from us is known as debtor. He will give money only on a future date. Here the two elements are goods and debtor. In the first case, when goods is sold for cash, there will be goods is going out of the business and cash is coming into the business. Here goods is sold to John on credit. Here goods is going out of the business, but cash is not coming into the business immediately. At that time, instead of cash, one person is coming to the business, that is Mr. John. He have to pay money in future. He is known as the debtor. So, in this transaction, the two elements are, one is goods and other one is debtor, that is Mr. John. The debtor have to pay money on a future date. On that date, also there will be two elements. One is Mr. John and other one is cash. Mr. John is paying cash to us and he is the debtor. So, the important point to be noted that in double entry accounting system, all transactions have two elements. The important point in the accounting is the modern accounting system is double entry accounting system, and in double entry accounting system, all transactions have two elements. That two elements have to be recorded in the books of accounts. Single entry system of accounting is practiced by certain small firms which is not regarded as a scientific accounting system. Nowadays also, single entry system of accounting is practiced by certain small firms, but that single entry accounting system is not regarded as scientific accounting system. Only double entry accounting system is regarded as a scientific accounting system. Luca Pacioli, an Italian mathematician, is the father of modern accounting or modern double entry accounting system. And according to double entry accounting system, for each transaction there must be two elements, or for every transaction there will be two elements. The two elements have to be recorded in the books of accounts, and hence two elements are involved. This modern system of accounting is known as double entry accounting system. So, in the coming videos, we are discussing only about double entry accounting system. That is the scientific accounting system practiced by all business organizations in the world. For better understanding of the accounting, we have to learn the important terms used in accounting. First term is economic events. What is an economic event? An economic event is known as a happening of consequence to a business organization which consists of transactions which are measurable in monetary terms. As we have already discussed that only the transactions which are measurable in money terms will be recorded in the books of accounts in the modern accounting system. Here, economic event means an economic event is known as happening of a consequence of a business organization which consists of transactions which are measurable in money terms. The transactions which are measurable in money terms only be recorded in the books of accounts, and the transactions which are measurable in monetary terms are known as economic events. If an economic event involves the transaction between an outsider and an organization, it is known as an external economic event. Economic events are classified into two types. First one is external economic event and second one is internal economic event. What is an external economic event? If an economic event involves the transaction between an outsider and an organization, it is known as an external economic event. For example, if when goods are sold to customers, an economic event happens. That means goods is coming out of the business and money is coming into the business. Here, this is an external economic event. Why? Because the transaction is taking place between the business and an outsider. The customer is an outsider to the business. So, this transaction is referred as an external economic event. In another case, purchase of materials from suppliers. Here, supplier is an outsider and the goods is purchased from the suppliers for use in the business. Here also, this is also an economic event. When purchase of materials are affected, money comes out of the business and goods comes into the business. Because this transaction is happening between the business organization and an outsider, it is also termed as an external economic event. Third one is payment of rent to the owner of the building. Most of the business organizations are functioning in rented buildings. When the business is functioning in a rented building, the business have to pay rent to the owner of the building. The owner of the building is an outsider as far as the business is concerned. So, the payment of rent to the owner is also an external economic event because as regards the business, the owner of the building is an outsider. So, a transaction between the business and an owner of the building is also an external economic event. Second one comes the internal economic events. If an economic event occurs entirely between the internal wings of an enterprise, it is known as an internal economic event. For example, supply of raw material by the stores department to the manufacturing department. If the business organization is a manufacturing unit, there may be stores department and manufacturing department. The stores department is procuring goods or raw materials from suppliers and storing it in the stores department. And that raw materials are supplied to the manufacturing department based on their demands. Here, the economic event happens because those our raw materials are transferred to the manufacturing department. However, this economic event is not between an outsider, not with an outsider. So, this is an internal economic event. Another one is payment of wages to workers. Workers are considered as internal people. So, payment of wages to workers is also regarded as an internal economic event. So, we have discussed the economic events, that only transactions which are measurable in monetary terms is known as economic events. Economic events are classified into two types, external economic events and internal economic events. External economic events are transactions between an outsider and an organization. Internal economic events are economic events occurs entirely between the internal wings of an enterprise. Examples of external economic events are sale of goods to customers, purchase of materials from suppliers, payment of rent to the owner of the building. Examples of internal economic events are supply of raw material by the stores department to the manufacturing department, payment of wages to workers, etc. The second set of terms to be understood are identification, measurement, recording, and communication. First, we can see what is identification. Identification means determining the transactions to be recorded. Only transactions of financial character related to the organization will be recorded. In accounting, we must take utmost care while recording the identification of the transactions for recording. Only the transactions of financial character related to the organization will be recorded in the books of accounts. Second one is measurement. It means the quantification of business transactions into financial terms by using monetary units. As we have already discussed that only the transactions which can be measured in terms of money will be recorded in the books of accounts. So after identification of a transaction, that transaction to be quantified in terms of money for recording into the books of accounts. After identification and measurement, that means the quantification, these transactions has to be recorded in the books of accounts. Once the economic events are identified and measured in financial terms, these are to be recorded in the books of accounts in monetary terms in chronological order. So first, the transactions of financial character has to be identified. Second, that identified transactions has to be quantified in terms of money, and that quantified transactions has to be recorded in the books of accounts in terms of money and in chronological order. What is the importance of chronological order? The transactions happened first should be recorded first. The transactions happened second should be recorded second. So if a transaction happens on 1st January 2020, that should be recorded first. The transaction happened on 10th January or 2nd January should be recorded secondly. The transaction happened on 3rd January will be recorded as the third transaction. That means the transactions should to be recorded in the order of date. So the second important terms to be understood are identification, measurement, recording and communication. First, the transactions which are to be recorded should be identified. While identification, it must be noted that only the transactions which are of financial character related to the organization will be identified. Second, the identified transaction has to be quantified in terms of money, and that quantified transactions has to be recorded in the books of accounts in monetary terms and in chronological order. Fourth one comes the communication. The economic events identified, measured and recorded has to be communicated in a certain form to the management and other external and internal users. The important function of accounting is the communication of the recorded economic events to the management and other interested parties of the business. The third important term to be understood is organization. For our purpose, organization refers to a business enterprise. The meaning of the organization may be different in other contexts, but as far as the students of accounting, organization to our or as far as we are concerned, organizations refers to business enterprise. Depending upon the size of the activities and level of business operations, business organizations are classified into sole proprietorships, partnership firms, cooperative societies, company, local authority, or any other association of persons. The business organization may be sole proprietorship. That means if a business organization is run by a single person, that is known as sole proprietorship. If a business organization is conducted by two or more persons, it is known as a partnership firm. Cooperative societies are organizations which are set up under the Cooperative Societies Act enacted by government. Companies are large organizations in which a large number of people will be involved. There are private companies and public companies. Local authorities are panchayats or other associations, or any other association of persons may be termed as organizations. However, as far as we are concerned, organization refers to business enterprises. Interested users of information. Accounting is a means by which necessary financial information about the business enterprise is communicated and is also called a language of business. Many users need accounting information for decision making, including external and internal users. Internal users includes managers, supervisors, etc. of company. External users includes banks, potential investors, tax authorities, labor unions, customers, etc. In the first video, we have discussed about the stakeholders of the business organizations. Here we are discussing the people who are interested in the information provided by the accounting. Accounting information is necessary for decision making. They are of great help to the internal and external users of the business organization. Internal users comes the managers, supervisors. External users includes banks, potential investors, tax authorities, labor unions, customers, etc. In the second video, we have discussed about the history and development of accounting and the important terms to be understood in accounting. In the third video, we are discussing the objectives of accounting and the basic terms in accounting. With this part 2 of the video is concluding. In third part of accounting basics video, we will discuss about the basic terms in accounting and objectives of accounting. If you are satisfied with the content of the video, please don't forget to like, share and subscribe to the channel. Thank you very much.